Good afternoon, everybody. As Brian just mentioned, my name is Theo Hildyard. I'm the Industry Director within the Cap Markets industry vertical for Progress Software. And I'm going to talk to you today about risk and compliance, some common themes that we are seeing emerging from within that area, within the context of exchanges, obviously. I'm also going to talk a little bit about what this means for exchanges and what the challenges and opportunities are that we see arising from that. Okay. So what are these themes that we're seeing? Well, first of all, clearly there's obviously some regulatory themes. So while we were talking yesterday about the degree to which regulatory harmonization is happening across the world, and that can be debated, but there are certainly some common themes that are occurring in regulation around the world. So the way that EMEA talks about moving OTC onto exchange and the way that Dodd-Frank does the same, clearly there's a common theme emerging there. There are also some common themes emerging around pre-trade controls, so the way that the market access rule in the US and the way that MiFID II and ESMA guidelines talk about pre-trade controls tells us there are some common themes emerging there as well. Also, automated pre-trade controls. I'm going to talk a lot more about that later in the presentation, so I'll just park that thought there, but I'm also seeing some common themes emerging around the extent to which automated trading needs to be monitored and controlled. Within the technology area, the move from T+1 to same day isn't really an emerging theme. It's been around for a long time. We all know about that. That's absolutely fine. But I thought I'd keep it up there because we're seeing it to continue to gain momentum and continue to solidify. So certainly the idea that same day and approaching nearer real time is better than T+1 is absolutely there. And we're also seeing an increased use of event-based technology, so complex event processing, real-time processing, to solve a multitude of sins. And I'm going to talk a little bit more about that later on as well. We're also seeing additions to the value-added services that exchanges would like to offer their clients. Now, I'm lucky enough to have a global role, so I do quite a bit of traveling, and I talk to a number of different exchanges around the world. And what I'm seeing from a lot of them is additional value-added services that they would like to offer out to their clients. Hosting and co-location has been around for donkey's years. That's well understood, no problem there. But I'm also seeing an increasing number of exchanges looking to provide pre-trade risk controls out to their clients. I'm also seeing an increasing number of exchanges looking to provide algo trading services out to their clients. Now, this would obviously be in markets that have less developed algo trading already, clearly. But in those markets, I'm certainly seeing exchanges talking about how they can provide algo trading services out to their clients. So there are certainly some common themes there. In the interest of time, there's no way I'm going to talk about all of these. What I'm going to pick on is the regulatory themes around controls of automated trading and do a little bit of a deep dive on that. So what on earth is required for the monitoring of automated trading? Okay, well, there are certainly some organizational controls. And actually, before I go any further, I'll just prefix everything else I say. The content that you can see on the screen here is taken from European-based text, okay? However, as I said in the previous slide, I do think there are common themes. I do think there's a harmonization of regulation around the world. So I think this is a useful conversation to have in a global setting such as this. But just, yeah, keep in mind, this is obviously European text that this is based on, okay? So a lot of bad press is hurled at algo trading, high-frequency trading and what have you. Some of it justified, some of it may be unjustified, but I think there's one thing that we certainly can agree on, and that is that HFT does introduce operational risk. If we increase the number of orders that are hitting markets and we don't have the capacity to process those orders, we're also going to introduce operational risk. So one of the organizational controls that's required of monitoring of algo trading is certainly to have capacity and resilience completely squared away. I think there's another element to it, which is around making sure that algos don't contribute to extreme market events. So yesterday we were talking about how algos and high-frequency trading did not cause the flash crash in the US a while back. But that's not to say that algos or HFT didn't contribute to the magnitude of that movement. They didn't maybe exacerbate the problem. So I think there's certainly something around controlling the extent to which HFT engines contribute to extreme market movements. Also something we're hearing, and this is a bit controversial, but also something we're hearing is the need to register algos. Now, this is a terrifically complicated area, and I don't profess to have it squared away. I don't think anybody does. I don't think the industry does. However, if you need to monitor algos, and clearly there's people are talking about a need to monitor algos, if you need to monitor algos, you also need to be able to identify them in some way. If you need to be able to identify them, you need to register them, give them a unique identifier. This implies that somebody somewhere needs to keep a list of those algos and somebody needs to manage that process. Now, I don't have a clue who that would be, and I don't have a clear idea about how that would work. But if we are going to monitor algos, clearly some registration process needs to take place. Okay. Some of the other things that people are talking about when it comes to monitoring algos is the need to ensure that algos actually provide ongoing liquidity irrespective of market conditions. And as I say, this is that's European language, but I think it's a point that's being talked about worldwide. So what does that mean? Algos need to provide regular and ongoing liquidity irrespective of market conditions. Now, to me, that sounds a little bit like a market maker. Now, maybe these algos aren't expected to provide double-sided quotes or be on both sides of the book, but we are expecting the algos, if you take this to its logical extension, we are expecting the algos to behave a little bit like market makers, and that infers that somebody needs to monitor the fact that they are actually providing that liquidity. Which I'll talk a little bit more about in a second. A third and final area about requirements for algos and monitoring of algos is to maintain an orderly market. And I think the requirements for this set are far more familiar to us. We need closer to near real-time surveillance. And absolutely, a pretty standard requirement. The regulators are talking about it. It's well understood. We also need some pre-trade controls, slightly different to the pre-trade controls that we talked about earlier. The pre-trade controls that we talked about earlier might look at an order flow and make a judgment call on the impact that order flow will have on the market if it executes. And if that impact is too extreme, they might do something. But I think there's another set of pre-trade risk controls that are around simply, is this a fat finger order? Is this an order that clearly looks like there's been some kind of mistake here? So some kind of pre-trade controls there as well, simply to maintain orderly markets. And I think a final area where we're seeing some new requirements emerge is around surveillance. The HFT and algo trading itself has brought about some new market manipulation types. So, for example, quote stuffing or ping orders, those types of things. And there's a list of them. There's a few more that the regulators have identified, but they're fundamentally new requirements of existing market surveillance systems. So I think there are three areas in which the monitoring of algo trading will actually introduce new requirements out there into the marketplace. Okay. But so what? So what? Who cares? Okay. So as a software vendor, I would like to say, and you might expect me to say, well, clearly this means that everyone needs to go out and buy lots more software, bucket loads of software, preferably from us. But actually, you know what? I'm not convinced that we do need to go out and buy a lot more software. I just think we need the right software. So if we look at some of these requirements, I think there are common themes that emerge here that are actually quite powerful. So for example, pre-trade risk controls. What exactly does pre-trade risk controls mean if we want to avoid algos contributing to a flash crash? Well, one way to approach that problem is to take a stream of events, look at those orders, ascertain if those orders executed, the effect they would have on the market, make a judgment call as to whether that would be extreme or not, and if it is extreme, block that order, okay? Fundamentally, a real-time pre-trade mechanism, okay? We look at the pre-trade controls that might be required for the fat finger errors as well. It's exactly the same. So we all, we can all understand what those types of controls might be. They're not actually that complicated. But you've fundamentally got exactly the same problem. Stream of events, a piece of logic that makes some decision and then acts upon it, okay? So a commonality there. I think there's another commonality in here as well, and that is around market maker monitoring. So we said earlier that in order that algos provide continuous and ongoing liquidity, irrespective of market conditions, they're starting to look a little bit like market makers. And the tools that we would use to monitor that they are actually doing that might look a little bit like market maker tools as well. So let's take an example there of what that might look like. It's a pretty simplistic example for the purposes of this presentation, but if we take an example whereby an exchange would simply want to look at the order flow coming from a uniquely identified algo, i.e. it has to be registered, by the way. We look at the order flow coming from a uniquely identified algo, and we work out where that position is in the market. If the market moves, and it moves in an extreme way, we then need to work out whether the algo follows the market, stays where it is, or drops out. If it drops out, we would do something. Again, it's exactly the same construct, if you like, which is a stream of events, a piece of logic, then we make a decision, and then we take an action off the back of that decision. So I think across all of these use cases, or rather across all of these elements of what might be required to monitor algo, there's an emerging theme around flow of events, managing flow of events, logic, decision, and then take action. Okay. While I think the fundamental idea is applicable to many different areas. Clearly, we've got many, many different actual business problems here. And just to pick out three, we've got pre-trade risk controls, we've got the need for nearer real-time surveillance, and we've got what to do with algo monitoring as well. So I'm just going to go into a little bit of those in a bit more detail and just talk about the challenges and benefits that I can see coming out of working with those problems. So how can exchanges implement multi-purpose pre-trade controls? This slide should actually be renamed to what's the first thing I should be considering, or what are the top things I should be considering if as an exchange I want to roll out pre-trade risk controls, okay? Excuse me. So I think the first and most important thing that needs to be considered is the need to balance robust controls, and by robust, robust can often mean complicated, with the need for low latency. So we can all imagine what these pre-trade controls might be. We can write them down on a piece of paper. We can certainly model them in Excel very, very easily. They're not that complicated. However, they can get more complicated as the business demand increases. And if you increase the complexity of this pre-trade control, you will also introduce additional latency. And more importantly, you'll make it more difficult to ensure consistent latency across all of your clients' pre-trade checks, which is presumably what they're going to demand of such a service, okay? So balancing the need in complexity between the pre-trade controls and the latency, I think, is probably the most important challenge facing pre-trade controls. Okay. How to scale to meet a large client base? I mean, that's not something that we can solve here in 20 minutes. This is all about the actual installation, the actual client, the number of clients, etc., etc., etc. But clearly, we need to apply some kind of pre-trade controls across the board. Otherwise, we'll be seen to be discriminating. So ensuring that can scale correctly is clearly a number one or a number two priority in this case. But I also think an important point is how to manage organisational hierarchies. So how do we want to do pre-trade controls? Do we want to do it at the desk level? Do we want to do it at the desk level but then aggregate up to an enterprise-wide level? Is an enterprise a child organisation of a parent organisation, and do we want to aggregate further? So those are critical business decisions that the exchange will need to take, clearly. But I think it's important to keep in mind that the more complicated you make that management of the organisational hierarchy, the more complicated the pre-trade control will be, and therefore the more latency issues you're going to have, okay? So there are some challenges around pre-trade control, but there are also some benefits. So the most obvious one, clearly ideally we've eliminated fat finger errors, erroneous volatility, and what have you. But I think another benefit to such a service is that it can actually be bundled and pushed out as a service. So this can form part of a differentiated service offering to clients. Okay? And I think the final benefit, and this is really the punchline to the presentation, if you haven't already guessed, that this is the final benefit is that, the idea that this problem can be solved with management of events, logic, decision, and then action is actually relatively commonplace technology. And you may have that inside your organization already. You may be able to reuse that. If you haven't and you buy it in, you may be able to reuse it across multiple use cases, which I'm going to discuss a little bit more in a second. But I guess the point is here, we've got a common problem. The actual business logic, the business parameters might be different, but we've got a common problem that can be solved by applying one CapEx investment in technology to many different areas. So let's just quickly, before I finish up, take a look at two more of those areas. How can exchanges identify flow from unknown algorithms? Okay, so I guess the first and most important point here is, does the industry register algos at all? And I'm not looking to comment on that in this presentation, but I am looking to comment on the fact that if you're going to monitor them, they do need to be identified somehow. Okay. But if we do have a registration of algos, and if we do have unique identifiers and some library somewhere that manages the registration of it, there's always the possibility that an unknown algo is going to pop up on the network and start batting orders into an exchange. Okay, and what do we do about that? How do we manage that? How do we spot that? I think this is probably the single most difficult problem that's affecting the entire area of monitoring of automated trading. This is a terrifically difficult problem. The end game would be to have some sort of crystal ball that tells you, okay, an unknown algorithm has popped up onto the network and it's placing orders. The end game would be to have that algo identified, the single instance of the algo that generated it identified, and ideally the strategy that it was trying to execute identified. But how you would do that technologically from an audit trail, from a data trail, is absolutely beyond me. But that doesn't mean to say that the entire problem is insurmountable. I think there are some baby steps that we can take. So there might be some characteristics of automated trading in general that you can identify, and a couple of very simple ones are clip size. If the clip size is low, it may be automated. Another one is the number of orders that are entering the system from a single source per second. If that number exceeds the number that a human can possibly do, you've got a good chance you've got an automated trading system sending it in. I think this whole area is dependent on the industry and vendors like ourselves coming up with other KPIs that we can use to identify the likelihood of flow being generated from an automated source. The confidence, if you like, how confident are we that this flow has been generated by an automated source? If we can do that, then I think we're going a long way to working out how to manage unregistered algos. The actual fundamental problem here, again, is flow of orders. Is the clip size low? Possibly algo. Flow of orders. Is the number of orders I'm receiving per second high? Possibly algo. So again, we've got a pattern of event management, logic, decision, blah. What would be the advantages of actually doing this? So clearly we can more easily attribute the extreme market event to an algo, but equally, by the way, we can defend algos if they're not actually, defend HFT and defend algos if they're not actually responsible for that extreme market movement. So this does work both ways. But again, I'd say the second benefit is that we've applied existing technology, we've got some common platforms that we've got in place, and we've applied it to more than one business problem. Okay. The final business problem I'm going to talk about that can leverage exactly the same risk and compliance technology, if you like, is how can exchanges move to nearer real-time surveillance? Okay, I'd say the first and most important challenge is around data volumes. Now, a lot of people, when talking about data volumes and surveillance, quite rightly, and real-time surveillance that is, quite rightly focus on, can my engines handle the throughput? Can they handle that number of events per second? Okay, and that's a perfectly valid question, and it's absolutely right that emphasis is placed on that. But I think there's a secondary question which doesn't get the merit it deserves in some circles, and that is we need to persist all this data. Okay, so if a regulator tells you you have to persist all this data for 5 years, you need a comprehensive data retention policy and strategy and God knows what else, and you certainly need a big investment in data retention technology. So I think those two questions run side by side, and I'd like to see them both given an equal footing, if you like. So I think oftentimes the former is given more emphasis than the latter. How can exchanges respond to a changing regulatory landscape? We saw earlier that automated trading and HFT have brought about new types of market abuse or new types of market manipulation that need to be surveyed for, quote stuffing and what have you. So fundamentally, organizations need to adapt to these changing requirements. So the question an exchange needs to ask itself, can my system do this? Okay? Can my system do this? If not, how easily and how quickly and how cost effectively can I do this? Do I need to do this myself, or can I get a vendor to do it? All of those questions are absolutely fundamental to how future-proofed a surveillance system is in the face of a very, very dynamic regulatory landscape. Okay? The third and final challenge, I would say, is how to reduce the number of false positives. This is the biggest single barrier to near real-time surveillance. There is absolutely no point whatsoever in knowing something is happening in the market a few seconds after it's happening, or even a few milliseconds after it's happened, if your inbox is so full, your surveillance analyst doesn't get round to dealing with that until 3:30 in the afternoon. There's absolutely no point whatsoever. The whole area of near real-time surveillance needs clean, high-quality alerts, needs clean, high-quality indications that something is amiss in the market, and to reduce noise from false positives. Okay? But if we can do all that, what are the benefits for the exchange? Clearly, we've got a improved reputation. We've got reduced reputational risk. So I absolutely firmly believe that business wants to do business in fair and orderly places, and that business attracts more business. Okay, so I think there is a competitive advantage in surveillance. It was talked about yesterday, and I'm talking again about it now. I absolutely think there is a competitive advantage there, and increasingly more and more the clients, if you like, of exchange services will start to demand this. Okay. Again, we've reused existing technology. Fantastic. One investment in technology, we've used it yet again. Market surveillance. It's all about a stream of events. It's all about some logic to tell me, has a news item occurred? Has a price spike occurred? Has someone avoided loss or made unnatural profits? Unnatural profits, and therefore then alert. Okay, so it's fundamentally exactly the same business problem, just a different representation of the business rules. Okay. And finally, one of the benefits, which isn't necessarily an often talked about benefit of market surveillance actually, but I think it is worthy of a quick mention. Market surveillance allows organizations to bring together into one place all of the data that has flown through that organization. Now, that data, and it's especially true in the case of exchanges, that information is an extremely rich source of information about what my clients are doing, how your market makers are performing, how your clients are performing, what they're trading, when they're trading. And exchanges know their business far better than I do, but intuitively that tells me that there's going to be information in there, customer insights in there that will allow exchanges to better market their products to their clients. Okay, so that's if you like, a value add from doing good surveillance, but I also think it's something that not enough people are making enough of. Okay, so in summary, what are we seeing? We're certainly seeing regulatory, technological, and value proposition themes emerging from within the exchange world, around the world. A lot of it is to do with pre- and post-trade risk and compliance tools, okay? But when you start to break down those problems, a lot of the problems start to look very, very similar, and a common technology can be applied to multiple areas. Now, that common technology needs to be extremely flexible because you're actually coding it up with different sets of business logic, but nevertheless, if you do have a flexible platform, you can reuse it across a number of different business problems and bring the total cost of actually doing risk and compliance right down by a single investment in single technologies. As a cherry on the top, if you can get better customer intelligence out of that data, then great. I mean, we firmly believe it's in there, just waiting to be tapped. So that's it. Thank you. Any questions?